So this is all my information, which will appear at the end, my links to my website and such. Next screen here. I'm going to tell you a little about myself. I'm going to take about 20 or 25 minutes, and at the end, you can ask me questions. I'm not going to take up a bunch of your time. All I'm going to talk to you about is how your money works and how you can make it work better for yourself. So to tell you a little about myself, I graduated from 2 colleges, State University of New York. One was at Farmingdale, one was at Brockport. My claim to fame in my career was running a fragrance company called Sovereign Sales in Michigan with my partner. In 3 years, we took it from 0 to 42 million. I have since become an authorized infinite banking practitioner, of which there's less than 200 in the country. There's about 50 in Canada. I know you see a lot of people online and everyone claims to be, an IBC guy, but I always like to say I am the IBC guy. What is infinite banking? Infinite banking is not an investment. It's controlling the banking function in your life. When you go to the bank and make a deposit, you're not making an investment. When you put money in a banking life insurance policy, you're making a deposit. It's not an investment. You can use that money for anything you want, whenever you want, without any penalties or tax implications. How did infinite banking evolve? Really evolved in 1980 when R. Nelson Nash, the gentleman who wrote the book, Becoming Your Own Banker, got into a cash crunch in real estate. He owned a lot of properties that he was a forester, so he had a lot of properties, and he got tied up when, if you remember back in the early 80s, the interest rates went up to 21%, 21.5%. He was paying interest of 23%, and he had a serious financial problem. Luckily for him, he had a lot of life insurance policies. So he was able to eventually get out of that mix. So becoming your own banker, what is it going to do for you? It's the solution for these problems. You've heard about velocity banking. A lot of people think velocity banking is infinite banking. It's not. Velocity banking, somebody else is still controlling the banking function. A lot of people use IULs or indexed universal life to do infinite banking. That's not the way to do infinite banking. Infinite banking should be done with a whole life policy, high cash value, specially designed so that you can use it for finance. The death benefit initially is reduced and we accentuate the cash value. And as you know, there's also term policies. With infinite banking, you doing it properly with a mutual life insurance company and a whole life policy, there's no risk. There's no cost because you're using money that you're currently spending, but I'm going to show you how to use it more efficiently. So it's not like you have to take money out of your pocket. It also puts you in control of the banking function. You no longer have to go to a bank and beg for money. You're going to be able to control the banking function, and you can use your money whenever you want for whatever you want. It gives you access without penalties or taxes. It's going to improve, if you have a business, your cash flow. If you have a household, your cash flow. And it's also going to allow you your money to have uninterrupted compounding of interest, which is very important. Most people don't fully understand it. And when it comes time for you to graduate from this life, you're going to be able to transfer your wealth tax-free to your beneficiaries. 2 books you should read, especially if you're in real estate or you have a business, is The Case for IBC, but you should certainly read Becoming Your Own Banker. It's available on Auditable. You can buy it. I think it's $21.95. I can also send you a PDF of it, and you can read it. You can obviously buy the book. But these are 2 books that'll give you a good understanding of what infinite banking really is, not just what you see on TikTok and YouTube. So I want to ask a couple questions to get you to think more like a banker, because we're trained to think like borrowers. So if your money was earning 4%, would it make sense to use your money as collateral and borrow against it at 6%? Anyone that thinks it would, put a 1 in the chat. And if you think it wouldn't, put a 2. So if you had money that was sitting somewhere earning 4%, would it make sense to use it as collateral? So let me look. Lircy, she said yes. See who else? Maxine. Okay, so we have a lot of people here that understand how money would work. So let's take a look at it. What makes more sense? You got $30,000 in savings, earning 4% interest. 5 years from now, that $30,000 is going to grow to $36,000. But if you collateralized it and borrowed the $30,000 and paid 6% interest for the same 5 years, you're going to only pay $34,799. You're going to have a net gain of $1,700. A lot of times when I show this slide, people say to me, how's that possible? It's possible because you are earning interest on an ever increasing balance. At the end of the first year, it's up to 31,000, 32, and it continues until you reach the 5th year and you're at 36, almost 36.5. But when you're paying a balance down, you're paying on an ever decreasing balance. So year by year, it's going down. Hence, you end up with more money doing it that way. I'm not saying that's what you should do, but I want you to think the way banks work. They borrow, they use your money, and they loan it out. And that's how they make tremendous returns. Albert Einstein said compound interest is the 8th wonder of the world. Unfortunately, most people don't understand it, so they pay it. But if you understand it, you're going to earn it. He also said, which is very important when you do infinite banking, he also said, imagination is more important than knowledge. Anything you can imagine that you want to do with your infinite bank, you can do. Whatever your business is, whatever field you're in, it'll work for you because you're in control. So let's look at how uninterrupted compound interest works. If you had a penny and it doubled every day for 31 days, when you got to the 31st day, you'd have over $10 million. But let's assume on the 22nd day, this is what most people do. Somebody in your family, a loved one, comes to you and they need to borrow $20,000 for something, and you have it in the bank. Most people say, I'd either write them a check or we'd go to the bank, I'd take the money out and I'd give it to them. But if you did that on the 23rd day, you'd have to start with a penny again. And by the time you reached the 31st day, you'd only have $2.56. But if you use the principle of infinite banking, your money will continue to grow. Essentially, you'll be using your money twice. I know a lot of you are in real estate. So how can this help you with your clients? I like to tell people when they come up to us at a trade show, they'll come up, and a lot of them are real estate agents. And I ask them, if you have a client that comes up to you and he says he wants to look at houses, do you drive him around like a glorified Uber driver? And all of them say no. So, well, what do they need? Oh, they need to have a pre-qual let. When you send that client to the pre-qual letter, let's say their credit is okay, it's just their debt to income ratio is too high. You send them for that pre-qual letter, they can't get it. When I ask the question, do you ever see them again? Most people tell me no. Well, if you send those people to me or my team, they can help them increase their debt to income ratio positively. And when we fix that, and whether it's 2 months, 6 months, or a year, we're going to turn around and send them back to you, which allows you to possibly recapture a commission that you would have lost forever. And the good thing is, when they get into that house, they're going to have a party. Not only are they going to invite their broker, their agent that sold them the property, they're going to invite their friends. And most of them, or a lot of them, will be in the same position they were in. And they're going to ask them, well, how did you get this property? So it's going to give you an opportunity to get more clients. So infinite banking can help them reduce their debts, which will improve their credit. We can show them how to pay off student loans, which hampers a lot of people getting a home. And we're going to positively influence their score. Why do we use whole life insurance rather than other products? Life insurance is the only vehicle on the planet that right now we know of where your money is compounding even while you're using it. It's essentially using your money twice. Instead of going to a bank, taking your money out, paying a debt, buying a property, buying a car, and the little interest that they give you is gone forever, your money is going to still keep working for you tax-free, the full amount. It takes you out of the tax loop. One of your biggest expenses in life is taxes. It's creditor proof, and it offers guaranteed growth. There's a lot of misconceptions that people have about whole life insurance. People will say it's too expensive. Well, the only way I'm going to use it is I have to die. And they talk about it as an investment. An infinite banking policy is not an investment. It's for banking. Banking is the most profitable, one of the most profitable businesses in the world. Look at any bank and see how much money they earn. So let's talk about what I see a lot of people do when they have a business. I see realtors do it. You know, as soon as they start making money so they want to have that look, they'll go out and they'll lease an automobile. And a lot of times they're not leasing Toyota Corollas. They're leasing BMWs, Lexuses, and cars like that. So let's take a look at two approaches at how this is done. Currently, let's say somebody has a lease. They're paying $10,000 a year on a BMW or a Lexus or some other car, and they do it for 4 years. So at the end of 4 years, they're going to have paid $40,000 to the leasing company. And at the end of that time, they have a decision to make. They can purchase the car, say for $30,000, or they can turn it in. What do most people do? Most people turn it in. So they're going to do it again. So 8 years later, they're going to have given the leasing company $80,000. And they still have a decision to make. So let's assume they do that for 20 years. 20 years from now, everything being the same, they're going to have given the leasing company $200,000 plus all the interest that they would have earned on that money, and they still have no car. They still have a decision to make. Are they going to buy it or turn it in? When you become your own banker and you fund a banking policy, you're going to do the same thing, but now you're going to lease the company, you're going to lease the automobile to your business. Your business is going to get the write-offs, but the money is going to come back to the leasing company. And the left side, that's somebody else. This side, it's you. So if you lease the same car for $40,000 or more, when you go back to trade it in 4 years, you're going to get trade-in value. You don't have to worry about all the nicks and dings that you have to do when you're leasing. 8 years from now, you're going to have over $80,000. And if you did it for 20 years, you're going to have the $200,000 back, plus all the interest that has compounded. which is going to be over $400,000 in your pocket just in automobiles, and you own the car. This is one approach where you can control something that you're doing on an everyday basis. So let's take a look at real estate. Let's just take about, if you're a real estate agent, you know that there's investors out there that flip properties. Let's say he has $100,000 and he invested in this property. He fixes it up. The problem is when he takes the money out of his bank, he loses the interest. But he sells the property for $120,000. He's on one property. If he can only do one property, he's made a $20,000 profit and a $20,000 return. Most people tell me, well, in a year, I can do more than that. So let's assume he can do 4 properties. He makes $20,000 on each. He keeps using that same $100,000. He's made an 80% return. But somebody that becomes their own banker, he's going to collateralize his $100,000. He's not going to take it out. You never take the money out of your banking policy. You use it as collateral. You're going to earn on one of the companies I use $5,200 in interest and dividends. You sell the property for $120,000. That same first property, you're going to make the same $20,000, but your rate of return is not 20%, it's 400%. Well, how can that be? Well, let's take a look at the next 4 properties. Let's say you did the same thing. 4 properties. You're going to make an $80,000 profit. Your rate of return is now 1,600%. Why? Because you're not using your $100,000. You're going to collateralize your $100,000 and you're going to borrow the $100,000 from the life insurance company, and they're going to charge you 5% simple interest. So if you do the math, the cost of doing this deal is only $5,000 because your money is still working for you. Hence, the returns are a lot better. When you start to think and act like a banker, you're going to make money just like a banker. And I want you to start to think differently than we've been trained to think. Some of you people know hard money lenders. They have a lot of money, they loan it out, they make a return. Some of you might even be hard money. Let's just use this example. They had $1 million balance. They want to loan out as much as possible. So they loan out $900,000. It leaves them a balance of, say, $100,000 in their bank. Let's assume they could earn 4% on that. They may have to deal with a bank and the bank's going to pay them 4%. We know that that's probably not possible, but let's use it in this example. So they're going to earn $4,000. Let's assume, and I know the numbers are lower right now, they may go up. Let's assume they're charging 12% on the $900,000 that they loaned out. They're going to make $108,000. The simple math tells you they just earned $112,000. But assuming they're in a 30% tax bracket, they're going to have to pay taxes. So their net gain after taxes is $78,400. But if they're their own banker and they had $1 million in their account, they're going to earn interest on it of $52,000. They're still going to earn the 12% on the $900,000 they loaned out. So their profit is now $160,000. But they do have to pay interest on the $900,000 that they borrowed. At 5%, that's $45,000. So now they made $115,000 profit. They got to pay interest just like they did before because it's a profit on a business deal that they made. Let's say they're in a 30% tax bracket, it's $45,000. The taxable gain is $70,000. I'm sorry, they got to pay interest, which is $45,000. So it makes their taxable gain $70,000. They're going to have to pay taxes on the $70,000. Let's assume they're still in the 30% bracket. That's $21,000. So if we do the math and we subtract $21,000 from $115,000, they just made $94,000. doing the same exact thing, but they're recapturing all the money that they'd be giving to somebody else. They're now pocketing themselves. So they just made an additional profit of $15,600 or almost 20% more. Let's talk about this. This is something we all can do. If you had a cash value policy and you had $100,000 in it, you're going to earn $5,200. Let's assume you want to buy a car or you invest in a piece of property and you borrow $50,000 at 5%. If we do the math, you still earned on your $100,000, you still earned $2,700. So my question to you is, where in the world can you borrow $50,000 and still earn $2,700? Nowhere, unless you're your own banker. This is how banks make money. Banks do not lend their own money. If you go to a bank and you have a savings or checking account, they call it a deposit. Essentially, you are loaning the bank your money. You're making a loan to the bank. Unfortunately, they're dictating the terms. So you loan them $30,000, they're going to pay you right now. It's gone up probably, but it's 0.4% interest. They're going to give you $120,000 in interest. You have to pay tax. So if you go to the same bank that you have the $30,000 in and you borrow $30,000, essentially, whose money are you borrowing? Well, you're essentially borrowing your own money. Are they going to charge you 0.4%? No, they're going to charge you 5, 6, 7, 8, maybe 10% interest. So they're going to pay you $120 on your $30,000 that you loaned them. But when they loan it back to you, you're going to pay $1,500 to $3,000. So my question is, what is the bank's investment in this deal? It's not $30,000 because that's your money. Their investment is only $120, the money that they're paying you in interest. So if you're paying $1,500, 5% interest to them, they just made an 1,100% return. If you pay 7 or 8%, 10%, they're making a 2,400% return using your own money. You can do the same thing. You just have to collateralize your bank. Once again, think and act like a banker, and you'll start to make returns like a banker. I hear this all the time from people. How can I pay a premium or a deposit and still pay my loan? How can I do that? I'm trying to pay my loan down. How can I pay it? I said, well, you're doing it right now. If you have a savings account, you're putting money in a savings account. You're saving money. Now you have to go get a loan. You got the loan from the bank and you're making payments. And if you don't pay them on time, you're going to get a late notice. You're going to do the same thing if you have your own bank. We'll call it your family bank. You're going to have your own bank and you're going to make a deposit into it. You want to call it the premium? Call it the premium. I call it a deposit. You're going to borrow the money without any approval from the life insurance company because your money's collateralized. The difference is you never have to pay it back. I'm going to show you why you should pay it back so you can do like banks and continue to use the money over and over. So my question to you is, who is the banker in your life? Because whoever controls the banking function controls the cash flow. How many times as a real estate agent have you had a couple good deals and then you hit a dry spell? Like right now may happen. Interest rates going through the roof. People, if they don't have the cash, they used to be able to afford that $500,000 house. Now they can afford a $200,000 or $300,000 house. Well, now they don't do the deal. So you run dry. When you have your own bank, you can borrow against it. Right now, a lot of people tell me they're using their credit cards and they get choked off and they're paying interest to somebody else. When you borrow from your own bank, no one is ever going to call you to make the loan payments. When you do the next deal, just repay the loan. So would you like to be your own banker? I have one final question. And the question is, do you want to control the banking function in your life? if you have any questions, you can either unmute yourself, put them in the chat. I guess Winnie will control the people asking questions. And this is all my information again. Let me just see if there are any questions in the chat. Not yet. So I am done. I'm going to unshare my screen right now. And yes, sir.
Hey, Bill, I have a question.
Go ahead.
Let's say I have $100,000. I want to start my own bank. And I know we have whole life insurance part of it. There will be costs associated with it. So how much money they will take to go toward the life insurance and other thing work? Can you elaborate on that for us?
Okay. It really depends, because I know we had this discussion a little while ago with you in particular. The numbers were different, but it really depends on the design and what your intentions are. Some people have a greater concern for a death benefit for obvious reasons. They may be older and now they're concerned about their children and their grandchildren. A lot of times when I speak to real estate investors, they're more concerned with the cash. So to answer your question, you put $100,000 in, by the end of the first year, you're going to have about, and I'm just taking a stab at it, you're going to have over $80,000 available to you by the end of the first year. How quickly? Let me answer the next question that may come up. Well, if I put money in, how quickly can I borrow it? Usually, typical whole life policies, it takes 2, 3, 4 years, sometimes 5 years. With an infinite banking policy properly designed, the first time you can borrow is 10 days after it's put in force. Sometimes a little sooner, but I like to tell people, give it 10 days, which is like 2 weeks. You'll be able to take your first loan. After that, it takes anywhere from 3 to 5 days. When you take a loan, to have that money deposited in your account, you can also have it wire transferred, which would take a day. So does that answer your question, Hansi?
Yes.
Okay. Any other questions?
Is there a minimum amount that you should have on the whole life insurance policy?
No, you start wherever you're at.
Okay.
What happens is, when I told Hansi about, putting in 100,000 and I squeeze down the death benefit so he has more cash. What happens with people, and I've seen it over and over again, they'll get one policy, they start where they're at, maybe it's $500 a month. Because we find money, a lot of times people have credit cards, they have mortgages, they have automobiles, and what they do is they don't pay the minimum. They'll pay more than the minimum. They overpay because the credit card companies put right on the statement, and this is why they do it. They'll say, if you pay the minimum, it's going to take 25 years and you're going to pay $38,000 to pay off this $5,000 debt. So what do? $500 minimum, minimum is $50. We owe $5,000. I'm going to add $500 to it. So I'm going to send $550. And if I do that for 10 months, I'm going to pay the credit card off. But what happens is we write the check or we send it electronically. As soon as the money's out of our account, we walk in the house, the hot water heat is broken. We need tires for the car. So we reach out and we take out our credit card. We call the guy up. He comes over. He says, I can fix your hot water heater. It's going to cost $450. So what do? Reach in, use our credit cards. We thought it was going down. It just went right back up. And they do that for a reason, because it's kind of like, I always tell people, they're all on cocaine. They want to get off it, but they don't know how. There is a way out of it. And the point is, the person that starts with a $500 premium that we found the money, the next one, it's usually, in almost every case, it's a lot higher, because they end up just like banks. They end up having more than one policy. They have a series of policy, just like banks have branches, and they'll have 2, 3, 4, sometimes 5 policies. Because what happens is when they have an extra 10, 20, 30,000 and they can no longer stick it in that first policy, they no longer want to give it to Wells Fargo or Bank of America and earn no interest. They'll want to put it in their policy, and I'll tell them, look, it won't fit. And they'll know, well, I need to open another policy. And that's when they can adjust the percentages of cash to death benefit. So I hope that answered the question. There's no minimum. You start wherever you're at. And it shouldn't be something that chokes you off. Done properly, it's going to help you. You just need to have discipline. If you don't have discipline, this will not work for you. You know, you need to have a plan to pay yourself back at some point, whether it's your next commission or you're going to pay every month, you're going to put a little in, but you're in control. Just like you go to a bank and you make a deposit when you have the money, it's the same thing here. If you have a policy and if you're putting in $1,000 and making a deposit in the bank, and 8 months from now, you only have $500. You don't lay in bed at night worrying, how am I going to come up with the other 500? You just deposit $500. It's the same thing with a banking policy. You have a policy for $1,000 a month, and 8, 10, 12 months from now, you're tight. For whatever reason, you went away, you had 2 bad months, you can't afford the 1,000. There are solutions. You can pay less. You can borrow from the policy to make the payment. There's options because you're in control. Unfortunately, we've all let bankers be in control, and that's how we think. We think that they're going to tell us, but when you set up your own bank, you're in control.
Hey, Bill.
Yes.
Let's say I open my bank with $20,000, for example.
Mm-hmm.
And then can you go through it? I don't want it to be a make. What do I need to do in order for it not to, and can you elaborate what is a make and for everybody to understand? And what do I need to do if I don't want it to be a make? And then what the process?
Well, the companies I use, well, let me explain what a MEC is because a lot of people don't know. It's called a modified endowment contract. That's in insurance terms. All you need to know is if your policy becomes a MEC, then what you're doing that currently would be tax-free becomes taxable. The companies I use will not let that happen. That is if you want to put too much money in, or you do something with the design of the policy. The companies that I use, if you sent too much money, they won't put it in. They'll notify you and say, what do you want us to do with this extra money? So the MEC part, if you deal with me and the companies I use, you don't really have to worry about it, but you'll understand it. Everyone that works with me or my team, what happens is, after they have a policy, when they get it, we go over it with them again to teach them, and we'll work with them until they really don't need us anymore. We're going to teach them how to take loans, how to pay back, how to do some of the things they want. And eventually they don't call us for that anymore. What they'll do is they'll call us and they'll say, look, I have $300,000. I want to buy this building. How can I run it through my policies so that I can buy the building, accomplish what I want, but I can still earn interest and dividends on the money? And also, if something happens to me, I have a death benefit that my family can still survive. So if you had $20,000 in a policy and you were putting in annually, well, if you had $20,000 cash that you can draw on, that's what you'd be able to borrow against, which would probably help you eliminate some credit card debt. If you pay off all you people are in real estate, so you know that the mortgage, the person that holds the mortgagee, the person that's paying the mortgage, usually in the first year at some point, they get a letter from the bank saying, you know, Hansi, no longer send your money to Wells Fargo, send it to Bank of America or whoever. What just happened? The mortgage didn't go away. It's just the debt got transferred to somebody else. When you have a banking policy, you're going to do the same thing with your debts. If you pay off Capital One using your banking policy, the only thing that happened is Capital One goes away because now you purchased the debt from Capital One. So you're going to continue to write the same checks out, but instead of sending to a third party, you're going to stick that money back in your pocket. So just think how quickly your money will grow. I have an example on a slide, somebody paying $300 on an automobile, but currently they're paying it to somebody else. Once they pay that loan off and they own the debt, they're going to pay the same $300 to themselves. But that's a $600 swing because the money's not going out anymore. It's going back and increasing their policy. So that's a $600 swing in their cash flow. It happens quick. And a lot of times when you watch, you know, online, people make this complicated. Infinite banking is simple. I tell everyone when they come to me, I always ask them, what are you doing right now? And they'll say, well, if you sold a property and you made $100,000 in profit, where's that money going? Sometimes they're hesitant to tell me. I go, well, you know, well, I'm going to do it. I'm going to use it for another deal. But where are you going to put the money? You're not going to hold it in cash. Oh, I'm going to put it in my bank. And then you're going to write checks out to other people to pay your debts, right? Or to buy another property, right? Yeah. You're going to continue to do the same thing. But when you have a banking policy, we're going to do one thing more. And we're going to do it first. When you get that 100,000, we're going to put it in your banking policy first. And then you're going to move the money from your banking policy into a commercial bank. And then you're going to continue to do everything you're currently doing, but you're going to put it in your bank first. Why are we doing that? It's going to increase your death benefit. It's going to increase your cash value, which is going to give you more interest and more dividends. And you're going to be in control. Anybody else?
Question, and I may have missed this. The amount of money that you can borrow is gonna depend on your initial investment, right?
It's gone. Yeah, you can borrow up to 100% of the equity in your policy. Okay, I don't want to get too complicated, but they hold a little just so that the policy won't collapse. Generally, it's about 97% of what you have in there. But yes, just like any business, when you start a business, you know, the first year or 2 or 3 years, you know, you're putting money in and you're really just taking money out to survive. But after that period of time, you can start taking money out. It's the same thing you're doing here. You're starting your own business, but the business is financed. And usually in most cases, depending on how it's designed, usually in the 3rd or 4th year, you're getting dollar for dollar. In other words, you put 10 grand in, your cash value is going up at least the same amount, usually about the 4th year, sometimes as early as the 2nd or the 3rd, sometimes as late as the 7th, depending on how it's designed and specifically for you. But yes, you have to capitalize the policy.
Okay,
Now,
and so I have another question.
Go ahead.
So say you started a policy and just for argument's sake, you started with 10,000 and you wanted to go in at a later time and had money. Can you add additional funds to the policy?
Yes, if it's designed. I hate to keep giving these answers, but And I know because when I spoke to Hansi, we had this conversation. He wanted to put X amount in, but then he said, I want to put more money. If I have this other money or I have this other money, I want to put it in. So the answer is yes. It's got to be designed that way. If not, what'll happen, and it's going to happen eventually anyway, you're going to end up, if you do this, if you follow the plan, you're going to end up with more money that you don't have currently because it's going to somebody else. You're going to end up with money in hand that you want to put in the policy. And as Hansi said before, you can't because it'll mech. But I don't have to tell you this because Maxine, when you come to me and say, Bill, I got $10,000, I want to put it in my policy. And I say, Maxine, you have no loans. You've maxed out your PUA. Your PUA is the banking portion of the policy, but you still have $10,000 in your hand. It won't fit in there anymore. My clients say to me, Bill, I think it's time I opened another policy, because that's going to happen every year now, because that money is no longer going to, as a friend of mine says, Skells Fargo or Skank of America. It's going into your bank. So, right now, look, you can't blame banks. They're in the business of making money. But the average bank, and you can look this up, you can go to the banking sites and look it up. The average bank makes a rate of return of 400 to 1,300%. And they don't have any money. They do two things. They use your money and they create money out of thin air. I don't know if anyone here knows what the Federal Reserve banking is. If you go to the bank and you put $1,000 in as a deposit, a businessman can walk in and he can borrow that $1,000. 9 other people can come in and they're going to loan the same $1,000 out. So where did the other 9,000 come from, Maxine? There isn't any. They make it up. Banks only have to hold 10% in reserve.
It's 12 o'clock.
Okay. So that, they create money out of thin air. You can't do that, but you can certainly make the money, the kind of money they're making, with less stress, because when you don't have the money, no one's going to call you.
So I have one more question and then I'm not going to ask anymore.
No, you can keep going. Go ahead.
On the insurance side. So say I wanted to purchase a policy for, say, my mom. Okay, how would I go about doing that? So this would be like life insurance for her.
Okay. So you actually asked a great question. I tell this to people that have policies on themselves already. I did this with a chiropractor, but it could be for anybody. When people buy life insurance policies, they do this. They usually buy a life insurance policy on themselves or their spouse to protect their children, or they may buy them on their children. I said this to them. Now, they have to be young. I know you're young, Maxine. We spoke before, but they've got to be like 25 to 40. And there's a reason. If they're in that age, a young professional making money, I said to this chiropractor, because that's what the age group he was in, do you ever think about buying a policy on your parents? And he looked at me, because I knew this guy was making investments into the stock market of thousands of dollars a month. So I said this to him. So it's very simple. I'll make it very simple. I said to him, if you took $1,000 and you set up a life insurance policy on your parents, and I knew he had a lot more that he could have put in. Let's assume if you're 40 years old, how old's the parent going to be? Probably 65 years old. So that's why they have to be young. I said, you're going to buy the policy. Let's just assume the death benefit was $100,000. Let's just say that they died the next month. What's the rate of return on $1,000 investment and $100,000 tax-free? Everyone tells me, oh, that's astronomical. There's no easy way of saying this, but you are going to be investing in your parents' death. And that's just life. There's no way around it. And then I said this to him. He got all excited. I said, look, What's the chances of that happening? It's slim. And you don't want it to happen anyway. So let's assume they're 65, but they're going to live 20 years. Now they're 85. That's more likely when they're going to possibly graduate. But you've invested $240,000 in the policy. But now you have a guaranteed tax-free return of $600,000. Where can you do that? You can't do that in the stock market. You can't do that anywhere. But actually, it gets better than that, because I told them this. Let's say 8 years into this, you need equipment for your business. You can borrow against the cash value, get the equipment for your business. The business gets the write-off. The business pays the money back to you. All the while, your investment, which is the death benefit, keeps growing. You can't do that anywhere. You take it out of your 401k, you're not going to earn interest and dividends on it. You take it out of your bank, that money's gone forever. You're going to use your money. Your money is going to continue to grow uninterrupted for the rest of your life. And you can do anything you want with it as long as you have a plan. Any other questions?
I have a question. So
Go ahead.
let's just say somebody wanted to start today, hypothetically, and they do not have a whole life policy, life insurance policy. What are the steps that they would need to take?
Okay, let's assume we talked and we designed a plan and everything's set up. We take an application. After the application, what everything's based on is your health, your wealth, and your income. That's how the policy is set up. But you would have the person, in most instances, some instances not, you would have to get, sometimes they're just going to take the information on the phone if you're young and healthy. As we get older and we're not as healthy, they're going to want to take a paramed exam. What does that entail? Usually it always entails drawing blood and a urine sample. Sometimes, as I just heard with somebody, it involved an EKG. About 20 minutes. They come, they go, they're gone. Then it takes, used to be quicker, but with COVID, everything changed. The world changed. And it'll take a week, 2 weeks, 3 weeks for the underwriting to approve them. Once it's approved, then the policy gets funded. It either gets funded annually or monthly. You couldn't do it quarterly or semi-annually, but most people either say, here's the 100 grand, I'm putting it in. Here's the 20 grand, I'm putting it in. Or they pay monthly. So there's a lot of things to do. I just had somebody that I know that they sold their property and they were going to take that money and pay off another piece of property that they own. And they decided to set up their own bank, take the money, open their own bank, borrow the money from their bank and pay the property. So now they're the mortgage owner, the mortgage holder on their own property. So that, they've accomplished two things and their money's still going to be growing. They're going to be earning, I think I remember it was like $7,000 on money that they used to buy their property. Where can you do that? You can't do that anywhere. Not when you're dealing with another bank. It's just changing your thinking. The other thing you can do is, you can own the policy on somebody else. You just have to have an insurable interest. So eventually you're going to run out of the ability to get a policy on yourself because your death benefit's going to be too high. Then you can take them out on your spouse, your business partners, your children, your father, whoever, and you can own it, control the money. You're just insuring their life. And at some point, if it happens to be a child, when you get old enough, say 85, 90 years old, and you don't need this money, you can sign the policy over to them to make them the owner, tax-free cash, tax-free death benefit. I don't know where else you can do that because even in a 401k, they're going to get taxed. And, the other thing is everyone doesn't, you want to pay as little taxes as you can, but you're going to have to pay taxes. Why put money in a government retirement plan and pay taxes 20, 30, 40 years from now when you don't know what the interest rate, what the tax rate's going to be. Why don't you pay the taxes now when you're 30, 35, 40, 45 years old, when you know what the rate is, so that when you get to be 75 years old and you take this money out with no intention of ever putting it back, it's all tax-free, rather than the government telling you at 75 how much you have to take out and how much of it is theirs. You know, you have $1 million in a 401k, 350,000 of it, it's going to be the government's. You have $1 million in cash value in your life insurance, $1 million is yours. Anybody else? Okay, I guess that's it then.
Thank you. This was amazing.
Thank you, dear.
Yeah, I'm here.
You're not here. Clearly.
Yeah.
It's like he was asleep and he just woke up.
Yeah,
Did
No,
you
no,
take a
no,
quick
I was-
nap? Did you
I
take
was
a
talk-
nap?
My son was talking to me, that's why.
Oh, okay.
Hey, Bill,
Yes.
I have a question before you leave there. Let's say I have a policy. And then let's say, let me using that 100,000. How long it will take me for me not to make a payment ever again on that policy, and then the policy is still kicking by itself?
well, there's a bunch of ways. Let's say you had 100 grand, you put it in. I don't recommend this, and I'm going to tell you what. Take 100 grand, you put it in. You never
Okay.
have to make another payment. And by the third year, you'll have your 100 grand all back with a pretty big death benefit. That is a MEC. It's called a single pay.
Mhm.
What I would tell somebody that has 100 grand and wants to do that, do a 2-pay. You're going to put 50,000 in the first year, 50,000 in the second year. We can even shorten it by prepaying, by backdating the policy 6 months. So you put 50,000 in, right away. The 7th month, you put the other 50,000 in, you got the 100,000 in, you never make another payment. It's done.
Okay.
But here's the thing, and this is what I'm going to show you when we talk about what we talked about last week. I'm going to show you why you want to continue to make payments, because I always ask people, are you going to stop going to the bank? Are you going to stop making deposits in the bank? People say no. Well, if you're not going to stop paying some other bank, why would you stop putting money into your bank? Because you don't have to put it in. But if you put it in, the cash value, understandably, if you put 100,000 in, 2 payments, and let's say life insurance has to go for 7 years. So we look at the 7th year, you may have 120,000 in it. But if you do the same thing, the 100,000, and you continue to make payments for 5 years, the cash value is going to be 180 or 190,000. But it's your choice. It's just like you don't have to pay back. I'm going to show you why you should. You don't have to put in. I'm going to show you why you should. I don't tell you what to do. The numbers, and you're going to make, whoever deals with me, when I show them the numbers, they all want to see an illustration. And I tell people, can you read an illustration? They say no. I said, then what do you need it for? When I'm done with them, they'll understand that illustration, and they'll be able to explain it to their life insurance guy that doesn't understand it. And they'll know why they're doing things, and they'll know why they should or shouldn't do things. When they have a question, they can call me, and we can help them. But if you just do if you would just do for yourself what we're doing for bankers, it'll make a drastic change in your life. We're just so used to doing things the way the bankers told us. That's why we're not told in school. We're not taught about financing. And that goes back to the Rockefellers and JP Morgans and all them. They never wanted finance taught in school because they're bankers. The First World War started because the sinking of the Lusitania. The sinking of the Lusitania was allowed to happen because there were 195 American citizens on that boat. And once they went down, it got the United States into the First World War. Why did we get involved? Because Britain was going to lose to Germany. And the bankers in Europe were going to lose a lot of money that they had loaned to England. And they didn't want that to happen. All you got to do is read the history. Everything that happened, my opinion, COVID, it's all about the money. The problem is the money is being controlled by somebody else. Why don't you just control it yourself? You know, who do you want the banker to be in your life? It's a simple process. Don't be afraid of it. It's not going to choke you off. And don't buy IULs. I would never sell one because an IUL is set up. There's two policies that life insurance companies love to sell: term policies and IUL and universal life policies. They're the most profitable product that a life insurance company sells. How can that be good for my client if I sold that to them? The least popular is an infinite banking cash value, high cash value life insurance policy. They don't really like selling them because they know that 30, 40, 50 years from now, they're going to pay somebody hundreds of thousands or millions of dollars because those policies don't collapse. And if you don't believe me, go to Google and just type in IUL lawsuits and see what comes up. Then after you spend a day and a half reading it, type in mutual life insurance and see what comes up. Mutual company, mutual life insurance company lawsuits. Nothing comes up. There's a reason for that.
Bill,
Yes, sir. I'm going to put up my screen one more time. So if anyone wants my information, go ahead.
this is a very refreshing class. And then I believe this is not the last class you are doing for us. We have a lot more coming because we are working toward that. But if you guys can see, Winnie, can you read for me what I put in the chat for our next class? And then is Cypher still here? Hey, Winnie, can you read? I put something on the chat. Can you read it?
Okay, so the next class is going to be on the 28th, same time, and it's going to be hosted by HSC and Quantum International Realty. And Mr. Cypher is going to lead the class. And the focus is going to be on teaching realtors how to become successful while investing and building cash flow.
So the reason why I put that class right after Bill class, because there is a correlation between these two classes. If we're gonna learn from Bill how to make the money or to get the money or to invest our money or to become our own banker, so that class, we need to learn how to make the money so we can become a savvy investor. Hey, Cypher, I don't know if you're here. Cypher, you still here? I don't know if Cypher still here. He was here earlier.
I saw him, maybe he dropped off, but you can speak on his behalf.
So what the main idea we're going to do at HSC Realty and Quantum International Realty, we want not only have realtor that's going to sell a property making a commission, we will teach all of our realtor how to become successful investor. In order for us to do that, we need to bring people that will teach you guys the proper way of becoming a successful investor. So next Saturday and 15 days from now, on the 28th, I believe, we will have a class with Mr. Quiseno, which is one of the best. He was the initial teacher that was teaching short sale and he has more than a few hundreds, a flipping, rehab and flip under his belt. is teaching people all over the country how to become successful investor. He's the right teacher for us to teach you guys the proper way of becoming a successful investor. And we need that. And then I want you guys to think that a realtor is not only showing a property, making a commission. There is a lot more we can do as a licensed realtor. And then I'm going to challenge all of you guys so we can get the best of you. I don't want somebody that's to be a realtor today, and then a year from now, when you call them, oh, I'll go to my 9 to 5. No, there is a lot of money we can be making in this business if we learn the proper way, if we become a team player and do what's need to be done. Bill, before I give it to Winnie, I want to give you your last word, so you can say whatever you want to say to end your presentation, and then I pass it to Winnie. Winnie can do the rest.
Bill, I have a quick question before you talk. Isn't Cypher one of your clients?
Yes.
Okay, I thought he was. Thank you.
Yeah, good question. Yes, Cypher does have a banking policy with me. We met at a trade show a couple of years ago, just before COVID hit, at the Dolphin Stadium. I don't know what it's called today, but we met there and we eventually set up. I've done some presentations at his office for some people. As a matter of fact, I just closed the case about 2 months ago, a month or two ago, for somebody else that used to be doing, it was with him, has moved on somewhere else. But so yeah, if anyone, the only thing I would say, I mean, I can, if I can get it real quick, bear with me a second. I'll put all my information in there. Well, here's what I'll do. I'll just put in my Book Me link. And if anyone wants to reach out, I'll put it in the chat. They can just reach out to me and set up a time and we can talk. I'm not, there's no high pressure. The more you learn about infinite banking, the more eager you'll be to do it. It's just for the first time in your life, you're going to control the banking function. It's not going to be an expense to you, because we'll find money that you're currently spending inefficiently. We're going to show you how to use it more efficiently. And when we do that, it's going to allow your money to snowball positively in your favor. Instead of bankers, or you people sell properties, and you all know that when you sell a house to somebody and they get a mortgage, that mortgage is paying for 2 houses, one for the person to live in, and the second house, all the interest is for the mortgage company to live off of. That's how they go on vacation and afford their homes. Why don't you just do it for yourself? With no risk and tax-free and other advantages. God forbid you happen to pass away, your family's protected. If you're a real estate investor and you're in the middle of 3 or 4 rehabs and you drop dead, well, now your wife or your husband or your partner is stuck trying to complete these rehabs. Instead, if they do it this way, the beneficiary is going to get millions of dollars, which is going to make that tragedy a lot easier to swallow. But that's the bonus. That's the extra. The banking policy is it's a bank, and the kicker is the death benefit, not the way life insurance salesmen sell it now. They sell it as a death benefit. They all do the same thing. I've never met the person, and no one has ever been able to tell me, do you know anyone in the world that's died more than once? I don't. So if you're only gonna die once, why would you invest all this money in a life insurance policy? If it's a term policy, you're never going to get anything out of it because usually you don't die. But why would you put all this money in a policy? And the only way somebody is ever going to benefit is you have to die. That doesn't seem like a good deal. But why don't you do the same thing and invest in a policy that you can use every day? Because you needed money yesterday, you need money today, you need money next week, next month, next year, until the day you die. Solve for your need for finance first. The death benefit, you'll have more death benefit when you die than the life insurance company would ever sell you. It's just, you've changed the tables and you're doing everything for yourself. It's becoming more popular. When I first did this 8 years ago, people would say, how come I never heard of this? How come everyone isn't doing it? I don't hear that anymore. Well, I don't hear it as much. What I hear now is, I've heard of that. I just don't know where to get good information. And the good information, you don't have to do it with me. Don't just pick any TikToker or YouTuber. Go to the infinitebanking.org website and pick one of those guys. Because at least they've all been trained properly. But if you want the best, then come to me, because I'm the IBC guy.
Bill, why should we go to somebody else we don't even know when I can go to your house, knock at your door, and then we can have a cup of coffee together?
I agree, but some people don't like me. I guess, I don't know. No, I mean, actually, I'll tell you a funny story. I had a guy just call me this week. He said, I've been doing this for years. I've looked online. He booked me. It was Monday, I think it was. And I didn't know who he was. Sometimes, people book and then they don't show up. This guy showed up and he said, I've been looking online for years. And I went to the infinitebanking.org website and I started looking for people. And he lives in Weston, where I live. And he goes, I wanted somebody close. I go, and you found somebody that lives in Weston. You said, oh shit. And he goes, yeah, that's what I did. And he lives like 3 miles from me. So I sent him free information, which I do for anyone that wants it. You can get it, I'm sure, from Ansi or Winnie can give you my information. I mean, I'll put it in the chat again, my email. If you send it to me, I took the wrong thing.
Bill,
Yes,
yesterday I was in a meeting with Miss Dana. I know Miss Dana is in the chat with us right now. He's listening to our conversation. And then Miss Dana is a very successful realtor in New York area. And then she always sent her client or a customer, however we call it, to a financial planner so they can plan their retirement and so forth. And then I gave her your phone number and your business card yesterday when I told you yesterday or this morning that I'm gonna set up some meetings, me and you and somebody else to talk. Miss Dana is one of them, and so she has she in need of this. And then you are the best out there with the information you giving out to people. I don't see. I've been going all over the place. I haven't seen it any better than that. Dana, if you hear me, can you? I know you hear. I saw your phone number. Miss Dana.
She's muted. She's muted.
Hello.
Yes.
Hello. I was sending a thank you in comments in the chat. I'm Donna Myrie. I'm a real estate agent in New York. I sell beautiful brownstones. I'm the triple B, right? Triple B, beautiful brownstones in Brooklyn. And I'm recently moved to Miami, so I'm doing a lot of my business virtually, and I have really great boots on the ground in New York. This is amazing. This infinite banking bill is something I've never heard of. I have spoken to many people who try to get me to buy insurance, and I know about term life. I know about whole life policies. Oh, thank you. Yeah, I would love to get that book. And thank you for showing it to me. Maybe you could send me the PDF.
Yes.
But what I've always done and I don't know what happens after I do this, but I refer my customers to somebody to plan the money that they're coming into as a seller's agent. So when I sell a brownstone and somebody's making $1.8 million, I refer them to somebody to help them to manage their money, figure out the capital gains and what have you. What's said in that meeting, I don't know, right? But I do refer. And for my buyers, I help them to become ready for buying, ready for the purchase, getting their credit together, getting their bills paid off, getting their parking tickets paid, getting their car payments up to, good credit standards, working out their debt to income and what have you. So what you said today was so amazing to me because it's necessary. And I think a lot of agents just don't know how prepared you have to get your buyer and your seller for this ultimate closing that we do. Everybody has to be ready and everybody has to have some way of scaling their wealth or scaling the money that they have in their possession. However, what you just presented today is the most amazing win-win financial thing I've heard. And I've been exploring the stock market and many other things, but this is amazing.
Well, Donna, the nice thing is you can continue what you're doing now. Those people can still eventually go to a financial plan, but they should put the money in their bank first because the money will always be there. But I don't like to berate financial planners, but what they do involves risk. Just like somebody that buys real estate, but you're a little more in control. You know where you're going to make and where you're going to lose. When you put money in the stock market, that financial advisor who may be great, he doesn't know when things are going to get out of control. And, one of the guys, I'm in a group with a gentleman, and he told me the other day, he goes, at this time of the year, I get GMO calls. I didn't know what a GMO call was. So I said, Tom, what's a GMO call? And he said, get me out. So if they put the money in their own bank, they can still, most people that want to have money in a bank, somebody else's bank, it's either or. They're either going to invest in real estate, they're going to invest in cars, they're going to invest in the stock market, whatever. When they put it in their own bank, it's either and. You can put the money in your bank and you can invest in stock, you can invest in real estate, you can invest in cars because you're in control. And it's a simple process. People complicate it. They like to show a million numbers. And I tell people, when I run an illustration, the minute I hit the button, the numbers are wrong. That's why I don't like to give them the illustration until I explain it to them. When I'm done explaining it to them, they'll understand what they're looking at, because that's when people get BS'd by financial guys because they don't know the numbers and they show them all this numbers. And when the client their eyes are rolling in their head, they say, trust me. I always have a different term for that, but trust me. The problem is not that you can't trust them, you just can't trust the world. So why not put it somewhere that you're in control of? Hopefully you can trust yourself, but this is risk-free. But like I said before, you
have another. The amounts that I heard of investing were like 20,000, 30,000, 100,000. But if somebody wants to start this, what is another number? I even heard 10,000. Can they become their own bank at say $5,000?
Oh, smaller numbers. Oh yeah, I just had somebody do it's $250 a month. So what is that? $3,000. But he's young and he's going to pay off all his credit cards and start. And I've had people, there's a gentleman on here I work with, he's had cases, and we've all had cases from time to time where somebody has $1 million or $2 million and they do what's called a two-pay. Put the million in the first year, they put the million in the second year, they're done. Now they've got a bank. and they never have to go to a bank. You know, just think of you know how easy it is when you close a real estate deal and you don't have to worry about a pre-qual letter because the guy says, I got the money, here it is.
Yes.
You know, it's the same thing here. Like that person that does that gets the $1.8 million or $1 million, he's not going to put it all in, but say he put, and I never like to take all their money out because they'll end up putting it in themselves because they'll see what happens. But if they put $1 million in 2 years, by the third year, they're pretty much going to have it all back, plus a death benefit, tax-free. So the next property they're going to buy or the houses they're going to buy, they can finance it themselves. They can buy it themselves cash. Then they can go refinance. Makes their life easier, makes your life easier, and their life is less stressful because now they're doing it. I need the money because I got to close next week. I own the property. If it takes a month or 2 weeks or 2 months, you know how banks are. They always want that little bit more blood right at the end. You think you got the deal closed and they want one more thing.
Thank you so
No problem. Yeah, if you send me an email, I put it in there, you know, the FEC South Florida Gmail. I didn't put, my other one is bill@creatingwealth.com. You know, I will, I do a video. I'll do a video so you'll see me, and I'll put in there the book, which is a PDF. I can also send the case for IBC, but there's an audio, which is two DVDs. And I've listened to that like almost 200 times. This book I've read 15. Auditable. I have the book on Auditable, which is about $21.95. So I listen to it. But the more you understand it, you know, it just like Einstein said, if you can imagine it, you can do it.
Absolutely. Thank you.
Hansi brought up something we were talking this week that no one ever said to me before. But then 3 days later, somebody said the same thing, but now I didn't have to think about it. I had already thought about it 2 days previous. So, you know, that's what I like to do. You know, the policies are one thing, meeting the people are one thing, designing them. And what I'm good at, which I think I separate myself from most people. I can do the numbers in my head before I even run the illustration. I can give a person 3 options. They pick one option. And when they pick one option, I give them 3 scenarios that they can do. When they pick one scenario, that's what they want to do because they always say, which one's the best? Give me advice. Give me your advice. Which one's the best? I say, I know which one's the best, but it might not be the best for you. You got to decide which one you want. And they're doing it based on knowledge and facts. Because when I do it, they know which one. But then when they do that, I give them the pros and the cons. I tell them, this is the pros, these are the cons. And sometimes they change after I do that, because now it tells them something that they didn't think of. But people buy more than one policy. You know, I have one guy right around the corner from me. He wanted one policy for his wife for $500. He bought 1,000 on her, 4,000 on him, 2,500 on one of his employees, because he sees he's financing his business with the policies. That's why he did it. You know, he doesn't intend on dying, but none of us do. But unfortunately, when he knocks, you know, when God calls us, we can't tell him, hey, give me 5. Give me 5 minutes. No, I mean, I'm calling you right now. So, you know, it's nice to know that you're protected, but you also now, you want to call it, you hear all the time about living benefits, you know, life insurance with living benefits. Well, why don't you just have your life insurance have cash value, and that's the living benefits? Hey, I want to buy a car. I'll do it myself. You know, I always tell people, go. When you go buy a car, what do they say to you? They pick the color, you pick everything, they take you by the arm. The first thing they do is they lead you down the hall to the finance company. Why? Because that's where the money is. They all have the same cars. They can't max out the profit on the car. They max out the profit on the financing. Well, I always tell them, go down there. Whatever deal they tell you is the cost. You know, you're going to have to pay $427.85 for this loan. Tell them, okay, thanks. I'm going to pay cash. And then take the $427.85 and just put that back in your life insurance policy. Now you just finance the automobile. And let's say you got a 5-year loan. In 55 months, you're going to have all your money back and you're going to have 5 months payment. That's all profit now to you that they used to make. I mean, it's very simple. It's just thinking differently, thinking like a banker. You know, for example, we looked at a policy one time and I told the agent, if you show him this illustration, just the way you showed it to me, he's not going to do it. He goes, why? I said, because when he's 70 years old, he's going to have a $4 million loan to his life insurance policy. I said, and some life insurance agent is going to show him that, and he's going to say, I don't want to do it. I said, but when he understands what he's looking at, he'll do it. Because here's what he did. He was 36 years old. He borrowed money for 34 years. This is what the illustration said. He borrowed money for 34 years, never made a loan payment, never paid a penny back. He borrowed $4 million. He still can borrow $2.3 million. And if he happened to die when he's 70 years old, somebody's still getting $4.6 million death benefit. Now, why wouldn't you do it? But you got to know what you're looking at. And my clients, when I'm done with them, they understand what they're looking at. Because if they don't, I don't let them move forward until they do. You know, I ask, what did I just tell you? Sometimes they can't tell me and we start over again. Sometimes I'm surprised. I don't think they get it and they repeat it back to me.
Okay, Bill, thank you very much. Let me, you did a wonderful job.
Thank
I know
you.
it's getting, you know, the classes was so important. So, and then people saying that this is the first class we spend that much time. And then I applaud you for the information that you're giving out to us.